You're in the home stretch now. The inspections and repair negotiations are complete. It probably feels like the hard part is behind you and the rest is just a waiting game. But there's a lot that still needs to happen before the home is yours. Welcome back. So far in this series, we've talked about everything from choosing the right realtor and getting your financing in place, to negotiating an offer and navigating your due diligence so you understand the condition of the home. Now let's talk about what happens between the end of the inspections and the day you get your keys. Hi, I'm Brandon King, realtor in Oregon and Washington. Now I'll walk you through the appraisal, what underwriting is doing behind the scenes, the conditional approval, title and hazard insurance, the final walkthrough, utility setup, what signing day looks like, and all the hurdles that we'll need to clear before closing day. When the inspection contingency period ends and you've decided to move forward with the home, your earnest money is no longer refundable if you get cold feet and choose to back out. But that doesn't mean you have no contingency protections left. The seller is still obligated to complete any negotiated repairs, and they must be able to clear any title issues. Plus, if you're financing the home, you'll likely still have an appraisal and financing contingency to protect you if something goes wrong. At this point, everyone's expectation is that the sale is going to close. The next major step is the appraisal. A lot of people get this confused, but this is not the same as an inspection. The home inspector helps evaluate the home's condition and identify problems. And while the buyer typically pays for the home appraisal, the appraiser actually works for the lender. Their role is to determine the market value and make sure the property meets the lender's standards and that the collateral for the loan is worth the sale price the buyer and the seller have agreed to. For a shorter closing timeline, the appraisal may need to be ordered soon after the offer is accepted. But for a longer escrow, it may make sense to wait and order the appraisal after the inspection and repair negotiations are complete and you're sure you're moving forward. There's no point in paying for an appraisal on a home you don't intend to buy. The appraiser typically visits the home and then compares it to other recent sales in the area to determine if the value supports the purchase price. Usually the appraisal comes in either at or a little above the agreed sale price and everything moves forward smoothly. If the value comes in low, the lender may not be able to move forward with the loan unless the difference is covered. This can open a fresh round of price negotiation, and the seller may agree to lower the price of the home to the appraised value, or you may choose to pay additional down payment to cover the difference. The buyer and the seller can also agree to bridge the gap together with some price reduction and some additional down payment. If no agreement can be reached, the buyer can use their appraisal contingency and back out of the home purchase. Usually the appraisal will support the value, but possibly note some repairs or safety issues that need to be addressed before the loan can close. These repairs would be the responsibility of the seller to complete before closing in order for the loan to be approved. Meanwhile, your lender is working to move your loan through underwriting and the final deep review of your loan file. They are looking closely at your income, assets, credit, employment, the property, the appraisal, title, and all the supporting documents needed for the loan. It's pretty typical to feel like the lender is asking you for the same document over and over again. They may be asking for updated pay stubs, bank statements, letters of explanation, the proof of the earnest money deposit, or other items that just seem redundant. Most of the time they aren't actually losing the documents you've already sent them. They're working on a complete and current loan file so that they can issue a final approval. If they ask for something, get it to them quickly. And a word of warning, do not make major financial changes. Don't go buy a car, finance furniture, open a new credit card, or move large amounts of money around without talking to your lender first. And definitely don't quit your job or get fired or change jobs if it can be avoided. Buyers get into trouble when they get excited and assume the loan is done and then get a little reckless with their financial decisions. Keep your head down and your wallet closed. A momentary loss of discipline could cost you the house. While all of that is happening, the title company is still doing their work in the background. They're making sure the deed can be transferred cleanly and that any issue gets resolved before closing. That can include things like old liens, missing documents, unresolved ownership questions, payoff issues, recording errors, or other title defects. If there is an issue, this is the stage where we want to catch and fix it. Most of the time, these get resolved quietly behind the scenes and you never hear much about them. But if something does get missed, the title insurance is there to protect you and your lender. Before closing, you'll also need to get your homeowner's insurance in place. Your lender is going to require proof of insurance before they will fund the loan. And over the last few years, insurance rates have risen quickly, and some insurers have even stopped issuing new policies in certain areas. So don't leave this until the last minute. Shop for insurance early enough that you have time to compare options, ask questions, and get the policy in place without scrambling the day before closing. If you're buying a condo, the HOA will have a master policy, but you'll still need your own coverage for the interior and your personal property. As you get closer to closing, you'll receive your closing disclosure. This is one of the most important documents in the transaction. It shows your final loan terms, interest rate, monthly payment, closing costs, prepaid items, credits, and the total cash you'll need to close. Review it carefully. Some small changes from earlier estimates are normal, but if there's something you don't understand or a number that looks way off, ask questions right away. You'll see your final cash needed to close, including your down payment, closing costs, and prepaid items, minus any earnest money already deposited and credits from the seller. Remember, be wary of potential wire fraud. If you're wiring funds to close, never rely on emailed wire instructions alone. Always verbally verify with escrow using a phone number you know to be legitimate. A day or two before closing, we'll usually do a final walkthrough of the home. This is not another home inspection. You're not re-inspecting the whole house from top to bottom. The purpose of the final walkthrough is to make sure the property is still in the agreed upon condition, that the negotiated repairs were completed, and that included items are still there. Personal belongings gone, trash gone, the garage emptied, unless of course something was specifically included in the sale. If there were major repairs completed as part of the negotiations, this may also be the time to have the original inspector come back out and confirm the work was done properly. That does cost a little extra, but usually not as much as the original full inspection. If the home has systems and features that need some explanation, it can also be helpful to do a walkthrough with the seller. Not every house needs this, but for things like drip systems, pool equipment, unusual appliances, hidden shutoffs, or special features, it can be helpful. Utilities should really be set up before closing, not after. I recommend buyers start getting utilities arranged about a week or two before closing. Some providers, especially internet or other services that require an appointment, may be booked out farther than you expect. The last thing you want is to get the keys to your house and realize that you have no utilities. Once your lender has final approval from underwriting and the closing disclosure has been sent, the title and escrow office will reach out and schedule your signing appointment. This is usually done at the title company, but if you're out of town or unable to attend, they can usually arrange for a mobile notary to meet you at your home, office, or wherever you happen to be. There's typically an additional fee for this. If you have a vacation or work trip planned that will take you out of the country, things can get really complicated, so let everyone know well in advance. You'll sign your loan and settlement documents, affidavits, and other paperwork needed to finalize the transaction. Bring a valid photo ID like a driver's license or passport, and be prepared for a thick stack of papers and a lot of signatures. The process is usually at least 30 minutes and can certainly take an hour or more. Understand that just because you've signed all the closing documents doesn't mean the home is yours yet. There is still one more step. Once you and the seller have both signed the closing paperwork, escrow sends the notarized loan documents to the lender and the lender funds the loan. This means they wire money to escrow so escrow can pay off any liens like the seller's mortgage and get the rest of the money where it needs to go. Then the title company records the deed with the county. Once the sale is recorded, the transaction is officially closed and ownership is transferred. Once the sale is officially recorded, we'll make arrangements to get you the keys. Assuming your agreement says the possession transfers at closing, we'll usually meet to get the keys the same day. If the seller negotiated post-closing occupancy to give themselves time to close on their new home and get moved out, the home may be yours on paper only while the seller still has possession for the agreed period of time. A word of warning, I've seen my share of home sales fall apart in this final stretch, and it's almost always preventable. Here are some of the most common mistakes buyers make that can cost them their new home or create unnecessary stress. Some of the big ones are ignoring requests from the lender or title company and opening new lines of credit, usually from financing furniture, buying a car, or applying for a new credit card. Another big one is moving money around without first talking to your lender, or worse yet, spending your down payment. Other common headaches include waiting too long to set up your homeowner's insurance or not setting up utilities in advance. And last but not least, wiring the down payment without verbally verifying the instructions. Wire fraud is real. At this stage, the best thing you can do is keep things simple, stay responsive, and be careful until the sale is officially recorded and the keys are in your hand. Once the sale closes, you are officially a homeowner. Congratulations. Welcome to homeownership. This is a huge achievement, and it may be new uncharted territory for you. In this next video, we'll talk about your first year in the new home. Everything from handling repairs, basic maintenance, keeping track of paint colors, warranties, and other records, watching interest rates for future refinance opportunities, and settling into the home. If you're planning to buy a home in Oregon or Washington and need help navigating the process, you can schedule a home buying consultation using the link in the description below. And if this series has been helpful, check out the other videos and subscribe so you don't miss the next video.